Hi, everybody. Welcome to another week. This is week 6 of our international business. Today, I'm going to review with you about what macroeconomics is, and then we'll go into chapter 9. The basic overview of what is macroeconomics. I have a couple PowerPoints to go over, and then, like I said, we'll go over chapter 9. Macroeconomics looks at the economy as an organic whole. Macroeconomics studies economic aggregates such as total output, total demand, aggregate income, total savings, total investment, total employment, rise and fall, and the general price level and interest rates. Macroeconomic study of the economy as a whole. We have the big picture, inflation, unemployment, contrast with microeconomics, national income, national output, and this includes the national, regional, and global economies. We have macroeconomics is a study of what's happening in the economy as a whole, the economy at large, the macroeconomy, the macroeconomics principal task to try to figure out why overall economic activity rises and falls, the value of production, total incomes, unemployment, inflation, immediate variables like interest rates, stock market values, exchange rates that play a major role in determining the overall levels of production, income, employment, and prices. Oops, sorry, I guess it's a commercial. Macroeconomics. Remember, macro is the big picture, and micro is smaller picture. It's smaller, meaning micro prefix means tiny, and micro would be larger scale. So looking at the differences here, we have microeconomics that analyzes individual income, analyzes demand and study of labor, deals with households and firm decisions, studies individual prices, analyzes demand and supply of goods. We have the macroeconomic studies national income, analyzes total employment of the economy, deals with aggregate decisions, studies overall price level, analyzes aggregate demand and aggregate supply. We have the macroeconomics versus microeconomics. By itself, the macroeconomics is only half of the economies. For more than half the century, economies has been divided into two branches, macroeconomics and microeconomics. Macroeconomics examine the economy as a large, focusing on the feedback of one component of the economy to another, and studying the total level of production and employment. Microeconomics study the market for single commodities, examining the behavior of individual households and businesses. They focus on how competitive markets allocate resources to create producer and consumer surplus, as well as how markets can go wrong. We have macroeconomics versus microeconomics. These two groups of economists differ their view of how the market works. Microeconomics assume the imbalances between demand and supply are resolved by the changes in prices, rises of prices, bring both individual additional supply, and follow the prices, they bring forth additional demand until supply and demand are once again in balance. Macroeconomics consider the possibility that imbalances supply and demand can be resolved by changes in qualities rather than in prices. That is, businesses may be slow to change the prices they charge, preferably instead of expand to contrast the production until supply balances or demand. Looking at macro and microeconomics, macroeconomics analyzes the economy as a whole, studies aggregate economic behavior of aggregate economic agents to aggregate economic markets, deals with the economic issues that affect the entire economy and most society, studies aggregate variables such as gross domestic product, national income, aggregate demand, aggregate supply, general price level and rate of unemployment, public deficit, exchange rate, etc. Microeconomics analyzes the individual components of the economy, studies the economic behavior of individual units, individual firm or individual household on the markets of particular goods and services, wheat, computers, oil, bicycles, gold, etc. It deals with decision making of certain form, a producer or a certain household or consumer. Studies such variables like the amount of the firm's output or the consumer's income, quality, demand, and supply of particular goods and their prices. Macroeconomics versus the microeconomics. In general, every generation, economists attempt to interrogate micro and macroeconomics by providing microeconomics, but no one believes the bridge between microeconomics and macroeconomics yet sounded built. Economists are divided between those who think that the failure of success integrate the two branches is a flaw that urgently needs to be correlated, and those who think it's regrettable but minor annoyance. Macroeconomics versus microeconomics. Like I said, macro is a large, so you can look at it as like a global scale, and then micro is smaller, like you and I. You think of micro like as like a small business or your personal finances. When we're looking at macroeconomics, we can see that economic theory here, theory of income and employment, you have theory of consumption, theory of investment, you have the theory of trade and business cycles, the theory of general price, and theory of economic growth, and macro theory of distribution, relative share of the wages and profits. Macroeconomic indicators, there are 6 key indicators of the economic activity. 6 key indicators is real gross domestic product, the unemployment rate, the inflation rate, interest rate, level of stock market, and exchange rate. The macroeconomic indicators collection of statistical information about the economy. The most commonly used country economic indicators include gross domestic product, output by sectors, private consumption, retail sales, volume, and employment, unemployment, average earnings, investment, productivity, inflation, producer, input, output services, current account, volume, trade of goods, services, export, and imports, and public debt and interest rates. Real gross domestic product. The first 2 are directly and intermediately connected to people's material well-being. The other 4 are indicators that control and profoundly influence the economy's direction. Real GDP, real means the measure is correct, the changes in overall level prices. Gross means the measure includes replacement of worn out, obsolete equipment and structures, as well as completely new investment. Real gross domestic product. Domestic means a measure counts economic activity, happens in the country, whether or not the workers are legal residents, whether or not the factories are owned by national companies. Product means real GDP measures the production of final goods and services. It includes consumption goods, things that consumers buy, take home or take out or consume, and investment goods like the machine tools, buildings, highways, and bridges that boost the country's capital stock and productive capacity. It includes government purchases, things that government acting as collective agent buys and uses. Real GDP is divided into imperfect measure of how well the economy produces goods and services that people find useful necessities, conveniences, and luxuries of life. It says nothing about the relative distribution of the nation's economic product, and it measures market prices, not user satisfaction, and imperfect measure of material well-being. Real gross domestic product, a nominal GDP. Definition values the production of goods and services as current prices or current dollar that we pay for things. Real GDP definition values production of goods and services and constraint prices. And the nominal GDP adjusted price changes. Formula, real GDP, nominal GDP price index. Nominal GDP is the total value of production using current market prices to determine the value each unit is produced. Real GDP, total value production using market prices to form a basic year to determine the value of each unit is produced. Unemployment rate. The number of unemployed people divided by the total labor force. The unemployment rate is the best indicator of how well the economy is doing relative to the productive potential. Inflation rate. A third key economic indicator is inflation rate. A high inflation rate, more than 20% a month, say it can cause massive economic destruction. The price system breaks down and the possibility of using profit loss calculations. Make rational business decision vanishes. Such exploits of hyperinflation are among the worst economic disasters that can benefit an economy. Strangely, moderate inflation rates, little to do with 10% a year, say they're highly unsettling to the consumer and the business managers. Moderate inflation should not seriously compose the consumers, investors, and managers' and ability to determine the best use of financial resources or calculate profitability. Yet these groups are strongly adverse to it. Politicians and the industrialized economists have discovered that they fail to preside over low and stable inflation rates, and they're likely to lose the next election. Inflation rate is a percent increase in the price level from year to year, and we can use the growth rate formula to calculate the inflation rate. We have interest rate. Through economists speak of the interest rate, there are actually more different interest rates applying to loans of different durations and different degrees of risk. The different interest rates move up or down together that the economists seek, and interest rates referring to the entire complex different rates, but interest rates do not move in concert all the time. The causes of variations in the yield curve, which describes the pattern of interest rates, are an important part of the macroeconomics. Whenever interest rates are low, that is, the money is cheap. Investment tends to be high because the businesses find that the wide range is possible. Investments will generate, though, enough cash to pay the interest on the borrowed money, repay the principal of a loan, and still produce a profit. The stock market. The level of stock market is the key economic indicator that you hear about most often when you hear about every single day. Let's try to avoid the news. The level of the stock market and the index of the expectations for the future. When the stock market is high, investors expect economic growth to be rapid. Profits can be high and unemployment can be relatively low. Here's some examples of what you might see. Call it bear market, bull market. Exchange rate, the sixth and last key economic quality is exchange rate. The nominal exchange rate is a rate in which the money of different countries can be exchanged one for another. The real exchange rate is a rate in which the goods and services produced in different countries can be exchanged one for another. The exchange rate governs the terms in which the international trade and investment take place. When the domestic currency is appreciated, its value in the terms of currency is high. Foreign reduced goods are relatively cheap for domestic buyers, but domestic made goods are relatively expensive for foreigners. In circumstances, imports are relatively high. Exports are likely to be low. When domestic currency is depreciated, the opposite is the case. Domestically made goods are cheap to foreign buyers, thus exports are likely to be high, but the domestic consumer and investors' power to purchase foreign-made goods is limited, thus imports are likely to be low. Here's exchange rates here. We can see Czech Republic, Denmark, Euro, Hong Kong, India, Israel, Japan. And the next one you see Euro, Japan, Korea, Philippines, and that's for Sony. New Zealand, Singapore, Switzerland, Taiwan, Thailand, United Kingdom, and USA. Economy and basic economic activities. An economy is a system of earning livelihood. An economy is just a group of people dealing with one another as they go about their lives. Another more common definition, economy is a system of 4 basic economic activities, such as production, distribution, consumption, and investment of goods and services. Production is transformation and inputs into output, finished products. It is creation of addition of utilities. We cannot produce Oh, sorry. We cannot produce matter. Matter is a free gift of nature. We cannot use more useful, transforming them into finished goods. Consumption is the use of goods and services, its destruction or decrease in utility in particular commodity. Investment, also called the capita information, is a production of new capital. Goods is addition of to existing capital stock of the society or economy. Distribution is a sharing of produced goods and services among various individuals and comprises this society. Circular flow, two sector models, household sector or consumption units. Classification of goods and services. We have classification of goods and services, non-economic or free goods, economic goods, final goods, intermediate goods, consumption goods, capital goods, investment goods. Some basic concepts. Consumption goods. Consumption goods are goods and services used directly by individuals, households for satisfaction of wants. Capital goods, investment goods. Investment and capital goods are goods used to manufacture other goods. These are goods used for future further production activities such as roads, buildings, roads and bridges, transport equipment. Immediate goods are goods that have to pass through further production process or meant for resale during a counting year. These are goods meant neither for consumption or for investment. Raw materials, fuels, electricity, etc. Immediate goods are not considered the calculation of national income. And final goods, those consist of consumption goods and investment goods. And final goods are considered a calculation of national income. Some basic concepts here: capital goods, reproduction here, immediate goods. Immediate goods are unfinished goods, the inputs, production of more final product. Whether or not something is called immediate good depends on the final decision. Final goods, tires sold at tire store are final goods. Final goods have reached their final consumer. They will not be resold to anyone. Some basic concepts here. Concepts of capital formation or investment. Gross domestic capital reformation. Gross domestic capital reformation is value of newly produced capital goods during the accounting year. Thus, gross domestic capital formation, gross domestic fixed capital formation plus the change in stock, whereas the gross domestic fixed capital formation is a value of newly produced fixed capital goods, assets within the country, such as roads, buildings, transport equipment, machineries, and equipment. Change in stock is change in the stock for investors of raw materials. And we have finished and semi-finished goods. And net domestic capital formation, gross domestic capital formation, depreciation, whereas depreciation and consumption of fixed capital is a decrease in the value of fixed capital assets due to normal wear and tear. Gross domestic capital formation, we have gross domestic fixed capital formation, change in stock, net, and depreciation. Some basic concepts: export. Export is of all goods and services to foreign countries. Import is the purchase of goods and services from foreign countries. Net export and export import. Net factor income from abroad. The NFIA is a factor income received from abroad, factor income paid to abroad. We have direct taxes. They are taxes imposed on income and capital. Indirect taxes are taxes imposed on goods and services. Subsidies are economic grants provided to certain cover up from losses suffered when the cost of production is more than the market prices. Direct, indirect tax. Indirect tax subsidies, transfer payments from non-factor income. Transfer payments are payments received without distributing anything. Production process, employment benefits, old age benefits, taxes with windfall products from speculation activities, say lottery, pocket money, gifts, etc. Some basic concepts: the flow of goods, exports, imports, net exports. Exports are goods and services that are produced domestically and sold abroad. Imports are goods and services that are produced abroad and sold domestically. Net exports are the value of a nation's exports minus the value of the imports. Net exports are also called the made in balance. Some basic concepts. Factor income. Factor incomes are the incomes generated by the owners of factors of production. These include wages, rents, interest, profits, etc. Components of factor income: income from work or compensation of employees, wage and salaries, the kind of cash, contribution to Social Security, income from asset or fixed property, income from financial property, income from the intellectual property, income from entrepreneurship or control property, profit, mixed income, self-employed. Factor income method was known as the income method and factor share method. NI equals the rent plus wages and the interest plus profit. In this method, income received by all basic factors of production or at the production process are summed up. Total factor incomes are grouped under three categories: labor income, capital income, and mixed income. Some basic concepts here is producing the sector income. In order to determine the output of the economy is classified into three broad industrial sectors, such as primary sector, secondary sector, and territory sector. Primary sectors include agriculture, mining, and quarrying, fishing, and animal husbandry. Secondary factor includes construction, manufacturing. Territory sectors include transportation, communication, storage, and other public utilities. Trade, hotel and restaurants, banking, insurance, and finance of professions, and business services, including accounting, software development, data processing services, business and management, consultancy, agriculture, engineering, and other technical consultancy, advertisement, business services, real estate, and ownership of dwellings. Public administration and defense, other services including education, medical, health, religious, and community services, legal services, recreation, and entertainment services. We have producing the sector of the economy. We have primary sector, territory sector, and we have another secondary sector. Concept of national income. We have the value of aggregate output produced by different sectors during given time periods. In real terms, it's the flow of goods and services produced in an economy of a particular period of a year. You have national income introduction as meaning definition here: the labor and capital of a country acting on natural resources produced annually to certain net aggregate of economies, material and immaterial, including services of all kinds. A national income estimate measures the volume of economies and services turned out in a given period, counted for duplication. And national income is a collection of goods and services needed for common basis, measured in terms of money, and defined as the total market value of final goods and services produced in an economy of given period time, and it refers to monetary value of the flow and the output of the goods and services of the economy during a period of time. I just wanted to go over that basically with you. And back to the microeconomics, it deals with the total aggregate level of output, aggregate level of consumption, aggregate level of investment, aggregate level of employment, and general price level of economy. Macroeconomics is from the Greek prefix macro, meaning large, of the economics, a branch of economics dealing with the performance, structure, behavior, and decision-making of the economy as a whole rather than individual market. This includes national, regional, and global economies. There's the three major parts of the macroeconomics that we talked about: unemployment, inflation, and output growth. In the United States, we had the Great Depression in the early 1900s. Then we had in the early 2000s, the Great Recession. And now they say we're maybe going to another recession. It's like some kind of weird hyperinflation that we're in. We'll have to see what happens. Of course, you saw that there was like 3 different banks this weekend, and they all started with S, which is really interesting, right? You had Silicon Valley, you had Signature, and then you had SBC. And they all start with S, so it's very confusing. But yeah, all of them all had issues this weekend, and they were asking for bailouts. People wanted their money back. Unemployment refers to a situation where the population of a country that do not work, and they earn their livelihood. Unemployment represents a ratio of the labor force in which they fail to get unemployment. Currently, 40% of Afghanistan population is unemployed. So we can see in certain countries, Afghanistan's 40%. If you go somewhere like Congo, there may be higher levels. I know in Zimbabwe is really not doing very well. I mean, to use the money to burn is probably what most people do for fire, because their money is worthless. And whenever people are talking in the news about the economy, they always mention Zimbabwe. Nobody wants to be like Zimbabwe. All right, so this is our chapter 9. So I just wanted to go over a little bit about the macroeconomics with you, because not everybody had macroeconomics or economy class, because this may be new to you. Some of you, it was your bachelor's, your AA program, certificate program. So you probably have already taken a lot of classes in macroeconomics, is one you may have taken already. But just in case you didn't. Okay. So why is the foreign exchange market important? The foreign exchange market is used to convert the currency of one country into a currency of another. It provides some insurance against the foreign exchange risk, the adverse consequences of unpredictable change in exchange rates. And the exchange rate is the rate at which one currency is converted into another. Events of the foreign exchange market affect firm sales, profits, and strategy. When do the firms use the exchange market? The exchange companies use the market exchange. The payments they receive and the exports and the income they receive from foreign investments, or the income they receive from the licensing agreements with foreign firms in the foreign currencies. They must pay for a foreign company for the products or services in the country's currency. They have spare cash that they wish to invest for short term in the money markets. They've involved currency speculation, the short term movement of the funds in one currency to another in hopes of profiting from shifts to exchange rates. Oops, sorry. What is the difference between a spot rate and a forward rate? The spot rate is a rate in which the foreign exchange dealer converts one currency into another currency on a particular day. The spot rates change consistently depending on the supply and demand for the currency and the currencies. Spot exchange rates can be quoted as amount of the foreign currency in the US dollar has to buy and the value of a dollar in the unit of long foreign currency. What's the difference between spot rates and forward rates? We have here. And to ensure a hedge against possible adverse foreign exchange rate, firms engaged in forward exchanges. Two parties agree to exchange currency and advocate a deal at some specific date in the future. A foreign exchange rate is a rate used for these transactions. Rates for currency exchange are typically quoted for 30, 90, or 100 days in the future. A currency swap is a simultaneous purchase and sale of given amount of foreign exchange for different value dates. The foreign exchange rate is a global network of banks, brokers, and foreign exchange dealers connected to electronic communications systems. If exchange rates quoted in different markets were not essentially the same, there would be opportunity for arbitrage. Future exchange rates are affected by a country's price inflation, a country's interest rate, and market psychology. The law of one price, this is how do prices influence exchange rates. The law of one price in competitive markets, the free transportation costs and barriers to trade. Identical products sold in different countries must sell the same price at the price expressed in the terms of the currency. Purchasing power. PPP argues that relatively efficient markets, the price of the basket of goods should be roughly equivalent in each country, predicts exchange of Relative prices result in change of exchange rates. The International Fisher Effect states that two countries' a spot exchange rate should the direction difference in nominal interest rates between the two countries. There's right here are respective nominal interest rates in two countries in the case of US and Japan. S1 is a spot exchange rate at the beginning of the period. S2 is a spot exchange rate at the end of the period. The investor psychology influence exchange rates. The bandwagon occurs when expectations on the part of the traders turn into self-fulfilling prophecies. Traders can join the bandwagon and move exchange rates based on the group expectations. Investor psychologies and bandwagon effects greatly influence the short-term exchange rate movements, and government invention can prevent the bandwagon from starting, but not always effective. There are two schools of thought. The efficient market school, forward exchange rate, do the best possible job of forecasting future spot exchange rates, and therefore the investing in forecasting services would be a waste of money. The efficient market school, companies can improve the foreign exchange marketing estimate of future exchange rates by investing in forecasting services. Two schools of thought on forecasting. Fundamental analysis draws on the economic factors like interest rates, monetary policy, inflation rates, and balance of payments. Information to predict exchange rates. Technical analysis. Chart tends with the assumption that the past trends and the waves are responsive predictors of future trends and waves. All currencies freely convertible. A currency is freely convertible when the government of a country allows both residents and non-residents to purchase unlimited amounts of foreign currency with a domestic currency. A currency is extremely convertible when non-residents can convert their holdings in domestic currency into foreign currency, and when the ability of residents to convert currency is limited in some way. A currency is non-convertible when both residents and non-residents are prohibited from converting their holdings of domestic currency into the foreign currency. When currency is non-convertible, firms must turn into a counter trade. And what do exchange rates mean for managers? Managers need to consider three types of the foreign exchange rate. Transaction exposure, the extent to which the income from individual transactions affected by influences in the foreign exchange values. Translation exposure, the impact of currency exchange rate changes in the reported financial statements of the company. The economic exposure, an intent to which the firm's future international earning power is affected by changes in the exchange rate. To minimize transaction and translation exposure by forward use swaps lead to lag payables and receivables. To reduce economic exposure, distribute productive assets to various locations so the firm's long-term financial well-being is not severely affected by the changes in exchange rates, and don't concentrate assets where likely rises in currency values will lead to increases in the firm prices of goods and services that the firm produces. In general, managers should have central control over the exposure to protect resources efficiently and ensure that each subunit adopts the correct mix of tactics and strategies, distinguish between transaction and translation exposure on one hand and the economic exposure on the other hand, and attempt to forecast future exchange rates and establish good reporting systems so the central finance function can regularly monitor the firm's exposure position and produce monthly foreign exchange exposure reports. Before we go on to more, let's go ahead and take a 10-minute break. Okay. Timer's on. Sorry, that's the wrong timer. You still have 4 minutes. Okay. All right, welcome back. So this is a little overview about international business. Chapter 9, we're talking about the foreign exchange. Here's an example of Japan Airlines. Explain how foreign exchange market it works, examine the forces that determine the exchange rates, and map the implications of the market. Foreign exchange market. Market converting the convergence of another country, exchange rate, the rates of another currency and another. Foreign exchange rates, risk arises from the changes in the exchange rates. Oh, excuse me. Currency conversion, companies receiving payment in foreign currencies need to convert their home currency. Companies receiving payment from foreign currencies need to convert in their home currency. Companies paying foreign goods and services. Companies, excuse me, spare cash for the short term in money markets accounts. And then your speculation, taking advantage exchange rates. Well, I need a Claritin. Sorry about that, everybody. Spot exchange rate, rate of current exchange on particular day. Two parties exchange agree to exchange currencies on specific future date. Go ahead and read the rest of it. I'm going to take a picture real quick. Okay, sorry, I'm back. Economic factors, balance of payments, interest rates, inflation, monetary and fiscal policy, international competitiveness, monetary reserves, government controls and incentives, importance of currency in the world. And then we have political factors, political party and leader philosophies. Proximity of elections or change in leadership. Expectation factors, expectations. Forward exchange market prices. Basic level rates. Determine the demand supply of another. And we have the price and exchange rates. Law of one price, competitive markets, free transportation costs and trade barriers, identical products sold at different countries. They must sell the same price when the price is expressed in terms of the same. Relatively efficient markets, few impediments of trade and investment, and the basket of goods should be roughly equivalent to each country. A PPP theory predicts that the exchange in relative prices will result in the exchange of the rates. A country with high inflation should expect currency to depreciate against the currency. And interest rates and exchange rates here. Theory says interest rates reflect expectations about future exchange rates. Fisher effect, international Fisher effect for the two countries. The spot exchange rate should change the equal amount, but the opposite direction to the difference. Evidence suggests either PPP or the international Fisher effect are good explaining short-term movements, exchange rates. Explanation may be investor psychology and bandwagon effect. Studies suggest the major player, the Big Mac Index Purchasing Power Parity of April 2001. Efficient market where prices reflect our available public information. Early studies seem to confirm the efficient market theory, but recent studies changed it. An efficient market where prices do not reflect all the available information. Use fundamental economic theory or technical price value or volume data analysis to predict exchange rates, analysis expressions. And that's the end of that one. Okay, let's look at some different strategies of entry. So we have exporting. This is indirect exporting, direct exporting. We have licensing and franchising. You have international alliances, international strategic alliance, international joint venture. You have the international cooperative alliance, and then you have direct foreign direct investment. Forms of exporting, indirect exporting, direct exporting, and passive. Indirect exporting means the firm participates in the international business through interdisciplinary and does not deal with foreign customers or markets. Direct exporting means the firm works with foreign consumers or customers and markets with the opportunity to develop a relationship. Direct and indirect and direct exporting. Direct exporting, e.g., indirect exporting meaning selling goods for foreign buyers. And export merchants are buying houses. This is a especially good mode of entry for a novice exporter or a manufacturer who lacks country knowledge. China is a good example. Many exporters do not have the expertise to enter the Chinese market successfully, but when they use indirect exporting, they offer their products through intermediaries who take the product directly to the market. This is a way to enter the Chinese market shorter, more flexible. Export management company, interdisciplinary, specializing in particular types of products or particular countries or regions. Export trading company, interdisciplinary, similar to EMC, but usually takes the title of product before exporting. Direct exporting, USA, General Industries, the UK, Boots Industries. We have direct exporting. More aggressive exporting strategy, where exporting take on the duties of interdisciplinaries and make direct contracts with customers in the foreign markets. Companies that treat and fill overseas orders like domestic orders, when it's about passive exporter, even with considerable revenues coming from International sales, the company mostly acts with the focus orientated on production management. Aspects in these cases, company normally has outsourcing of all international consumers. Does not have the capacity to export with its own brands. The company is more concerned with producing than commercializing. We have exporting advantages and disadvantages. Relatively low financial exposure, permit gradual market entry, acquire knowledge about local market, avoid restrictions on foreign investment, disadvantages vulnerable on tariffs and taxes, logical complexities, potential conflicts with distributors. Licensing is when a firm called licensor leashes the right to use intellectual property, technology, work methods, patents, copyrights, brand names, or trademarks, and others called license to return of the fee. The property license may include patents, trademarks, copyrights, technology, technical know-how, and specific business skills. Licensing process, licensor rights to use intellectual property. License uses the intellectual property to create products, passes royal to the licensor, and earns new revenues with low investment. Provisions include license agreement, effective date agreement, names and addresses of the parties, territory marks, exclusively, non-exclusive for some combination goods and services, duration, sub-license. No. If permitted, and quality control and standards, prescribed use of the trademark, royalty and other payments, termination provisions, other terms and conditions. Stop. Now let's see. Sorry, my cat bit my other one. She got too hyper. She was giving him kisses and then she bit him. Sorry about that, everybody. Low financial risk, the low avoid tariffs. License provides knowledge of the local markets. Disadvantages, limited market, opportunities and profits, potential conflicts with license, possibility of creating future competitors. Stop, you guys. Now I have to show everybody what you guys look like. You're being naughty or nice? Be naughty or nice? Say hi, everybody. Say hi. We're sorry. We were making noise behind you. My girlfriend got carried away and bit me in the head, right? Yeah, she's biting you in the head. Tell her to knock it off. Yeah, so I have 4 cats and 9 chickens, baby chicks. And then I got these 4 cutie pies. I got 2 right here. All right, so the product characteristics of target country, the nature of the company. Franchising, under franchising, independent organization called franchise operates business under the name of another company called franchisor. In such arrangement, the franchisee pays a fee to the franchisor. And franchisor is a form of licensing, but a franchisor can exercise more control over the franchise as compared to licensing. Licensing, franchising agreements, franchisee has to pay the fixed amount and royalty based on sales. Franchisee can agree to adhere to follow the franchisor's requirement. Franchisor helps franchisee establish the manufacturing facilities. Franchisor allows the franchise some degree of flexibility. Franchising advance and advantages, low cost risk, low cost way to assess market potential, avoid tariffs, NTB restrictions with foreign investment, maintain more control in licensing. Franchise provides knowledge of local market. Disadvantages is limited market opportunities, profits, dependence on franchise, potential conflicts with the franchise, and possibility of creating future. When you want to choose to do franchise, I think of them like McDonald's. Those are some examples. Newer unique business models, high degree of control, and brands are easily identifiable, and systems that can be copied. Procedures are well developed and easy to train. The difference between licensing and franchise. Mhm. We have international strategic license, international joint venture, and international competitive alliance. Agreement between two or more firms in the different countries to cooperate in any value chain activity of R&D sales. Example is Apple. According to overview of strategic alliances, Apple has partnered with Sony, Motorola, Philip, AT&T in the past, and Apple has partnered more recently with Clearwell in order jointly developed by Clearwell's e-discovery platform of the Apple iPad, and the e-discovery is used for enterprises and legal entities to obtain documents information for the legally defensible manner, according to 2010 press release. Starbucks partnered with Barnes & Noble's bookstores in 2093 to provide in-house coffee shops benefiting both the retailers. In 1996, Starbucks partnered with PepsiCo to bottle, distribute, and sell the popular base drink Frappuccino. A Starbucks Limited Airlines alliance resulted in the coffee being offered on flights with Starbucks logo and the cups in partnership with Kraft Food. Results of Starbucks coffee being marketed at grocery stores. Agreement with two or more firms and different countries have an equity or ownership position and a separate country. Mitsubishi Heavy Industries, having been concerned entirely with engineering, while Mitsubishi Group's own trading company handles all its marketing. Tech Moving Earth Equipment and Industries Refrigeration Equipment, respectively, and the U.S. Mitsubishi Heavy Industries thus benefited from the partners' expertise in marketing and after-sales service. Now the motor vehicles division of Mitsubishi having formed into a separate company, a joint venture has been set up with Chrysler, to which the later began 15% participation and the option to increase to 35%. Now, not only is the company currently exporting some 4,000 units a month to America, but sales in Japan has greatly increased. And the International Competitive Alliance, the international cooperation between more companies from different nations that set up legally separate company. The largest share of revenue in Global 300 is France, which guarantees 28%, and followed by United States, Germany, Japan, Netherlands, United Kingdom, Switzerland, Italy, Finland, Korea, and Canada. Local partners, knowledge of the market, local government regulations and requirements, sharing risk among partners, sharing technology. Many complicated issues solved through alliances. They provide the parties with their strengths, helps the developing new products, their interaction of two or more industries. Meet the challenges of technological revolution, manages having outlay, and become strong to compete with the multinational company. Companies enter international market through the FDI. They invest their money, establish manufacturing and marketing facilities through ownership and control. And the greenfield strategy, the term greenfield refers to starting the operations in the company to scratch the foreign market. Major FDI and telecommunications sector of Pakistan has come from cellular companies like Mobilink, Pactel, Patcom, Warden, and Telenor. Pakal and Patcom, Malaysian-based, entered Pakistan in 1990. Mobilink based, Egypt-based 1994. Telenor, Norway-based, and Warden 2005. Top countries FDI. Advantages, infrastructure, technology transfer, unemployment of the country, consumer benefit, increase in savings and investment. And disadvantages of foreign direct investment. Foreign direct investment can sometimes hinder domestic investment as it focuses resources elsewhere. Occasionally, as results of foreign direct investment, exchanges will be affected, the advance of one country and determinant of another. Foreign direct investment may be capital intensive from the investor's point of view, and therefore sometimes high risk economy is non-viable. And the rules of governing foreign direct investment. Exchange rates may negatively affect the investing country. Investment in certain areas is banned in the foreign markets, meaning inviting opportunity may be possible to pursue. And then, of course, we have considerations while entering the foreign market. Funding capabilities, local government regulations, cultural and demographic distance, political and financial risk, and the need for control. Lastly, let's look at the emerging markets. To understand specific concerns can be considered the international manager dealing with emerging market economies, to survey the vast opportunities to trade offered by emerging market economies, to understand why economic change is difficult and requires adjustment, and to become aware of privatization offers new investments for international trade and investment. It keeps sliding down. Doing business with transition economies. Here's some examples. Some major economic economies emerging out of formerly centrally planned economies are Russia and now the independent states and the foreign Soviet Union, Eastern and Central European nations like Albania, Bulgaria, Czech, and Slovak republics, Hungary, Poland, and Romania. And the trade histories of socialist countries. After 1918, the socialist economy had a monopoly of foreign trade, which concentrated on the hands of organizations specifically authorized by the state. This trade structure isolated the firms and consumers from the West and unlinked demand for supply. And the result was misallocated resources, ineffective channels of distribution, and ineffective due to the lack of completion. And managers in the plants were concerned with the producing of quality stipulated by the rigid central plan, producing products and quality desired. Changes after 1889. With unexpected sadness, the Iron Curtain disappeared, and within 3 years, the communist empire ceased to exist. And Eastern Europe and the foreign Soviet Union shifted political economies, orientations toward the market economy, and trade flows were redirected. Austerity programs were introduced, which led to the decrease of the standard of living, and all of the changes ended Cold War. Many transition economies face infrastructure shortages. Capital shortages are also a major constraint. It's difficult for corporations to respond to demand because the consumer knowledge is vague, and allocation mentally or waiting for the instructions from above represent a manager problem. Employee and manager commitment can be hard to find. The changes complicate managerial decision-making. The realities of economic change. Given the poor market orientation of the previous government, managers must adapt their behavior in these areas. Team building, problem solving, decision making, and customer orientation development. Adjusting to global change, resistance to change should be expected in countries that experience rapid economic and political change. We established market economies for the West and must be prepared for change due to reorientation, trade flows, job shifts, and declines in employment. International business challenges. The frequent unavailability to convertible currency makes many products out of reach for citizens' emerging market economies. Lack of protection of intellectual property rights dissuade firms from investing in emerging market economies. Attempting to source products from emerging market economies can be problematic. The quality of products can be inferior to emerging market economies. Some transaction economies have products that are unique to perform and can be successfully traded internationally. Consumer products of transition economies gaining favor because of competitive pricing. There's substantial opportunities to technology transfer. 3 reasons existence of state-owned enterprises and enterprising Market economies are increased national security, increased economic security, the investments too large for the private sector, government rescue failing private enterprises, placing them in government ownership, state-owned firms more socially orientated than private firms are product orientated. State-owned enterprises and international business. There are three types of activities where firms are likely to incur state-owned enterprises: market entry, the sourcing of market process, and international competition. Drawbacks to state-owned enterprises: competition is restrained, results are lower quality of goods and reduced innovation. International competitive state-owned enterprises declines, resulting in need of government subsidies, and many government-controlled corporations are losing money because they focus on job allocation rather than business. Throughout privatization, budgets can be reduced and more efficient services can be provided. Goods and services can be more competitive and innovative. Experience indicates private enterprises outperform state-run companies. Privatization attracts foreign investment capital, and governments can proceed from privatizing and help fund other pressing domestic needs. Existing firms can be acquired at low cost, often with governmental support through tax exemptions, investment grants, special depreciation allowances, and low interest credits. Since wages are low in countries where privatization takes place, there is more opportunity to build low-cost manufacturing and sourcing base. The international firm can act as a catalyst by accelerating the pace of transferring business skills and technology and boosting trade prospects. We have the less developed markets. The less developed markets could be in continents like in African countries, Asian countries, Eastern Europe countries, Latin American countries, and the Middle East countries. And the emergence of these markets represents great opportunity for citizens and companies alike. Here's the annual per capita income in the tiers and world population. This is a nice pyramid to describe that. And then we have multinational firm role. Multinational firms have experienced a high rate of success when entering transition economies for several reasons. They tend to enter sectors that allow high profit potential and minimal capital investments. They increase the size only after they gain experience and knowledge of the local markets. The government transition the economies afterward, special privileges to multinational firms, and multinational firms mature in these economies, then the domestic market itself becomes a market opportunity. World-class competition. Many economies now recognize that there could be world-class competitors in order to develop business, and domestic firms enter a joint venture with global firms to tap their knowledge base and success. This can be difficult. Even domestic firms rarely have significant capital to distribute. All right, so we're done for today. Make sure you do those summaries and turn them in, and I'll see you next time. Bye. Have a blessed week.